Welcome to this morning's webinar on responsible digital credit. We're about to get started, but in the meantime, the first thing that we wanted to do is put up a poll on the screen to better understand who we're talking with today. So if you can please just take a second to answer the poll, and we'll give like 30 seconds and then we'll get started with the show. Okay, thank you very much. And now for the second poll, we would just like to ask everybody what their geographic location is, so we have a better idea on who's listening in and from what part of the world. So if we can take 30 seconds for that, please. Thank you very much for that. Now we would like to welcome all of the participants. But first, before we begin the presentation, we want to go over a few housekeeping details. We have muted all participants for this presentation, but please, if we will call on people individually if they raise their hands. So if you have a question or a comment that you would like to make, please raise your hand by clicking on the little item that looks like a hand on your screen. And we will call upon you when the Q&A session part of the session starts. Participants can, when we call on a participant, you can use the chat function to ask questions, or you can reach out directly for help if you are experiencing any technical difficulties. And just to let you know as well that we are recording this session and we'll be sharing it on our website afterwards for those who want to participate but are not able to do so. So in case you want to share this with any other colleagues at your institution, we will be providing, after the webinar, we will be sending out an email with the direct YouTube link for the recorded session. And so before we begin, I would like to introduce myself. My name is Pablo Anton Diaz. I'm a research manager here at CFI. And as part of our responsibilities here at CFI, we manage CFI's Fellows Program. This fellow program it was designed to generate research on some of the most pressing questions facing the financial inclusion industry. It was launched in July 2015 with the purpose of encouraging independent researchers and analysts to systematically examine some of the most important challenges in financial inclusion. Each of our fellows conducts research, analysis, or writing on a topic of high importance to financial inclusion and produces a paper to be published and disseminated by the Center for Financial Inclusion at Acción. We really look forward to being able to continue this work year after year and being able to continue to promote all of the different reports that have emerged from this program in order to facilitate the generation of insights that will advance financial inclusion around the world. And without further ado, as one of those, we are very excited to be able to present one of those reports. And one of the fellows from our cohort for the last year for 2017, John Owens. John Owens, as everybody probably already knows, is an attorney and senior advisor who provides technical advisory services, training, and research, as well as managing several international development efforts focused on digital financial services, digital payments, financial inclusion, and ancient networks, and he has been doing this for more than 25 years. He has worked extensively with both regulators and policymakers across different regions such as Latin America and the Caribbean, as well as Asia, Pacific, Africa, China, Eastern Europe, Russia, and the Middle East. And so without further ado, John, the floor is yours.
Thank you very much, Pablo. And I'd like to really thank everybody at the Center for Financial Inclusion and the SMART campaign who made this research possible, as well as everybody from around the world who over the last year and a half have provided quite extensive inputs into this research. So I'm excited to share what I learned and what many of you were able to share with me. Can we go to the next slide? So when we're looking at, when I was doing this research and coming up with a definition for digital credit, we're basically looking at credit loans that are accessed through a digital channel, either online through a mobile device or in some cases through a third-party agent. Next slide. The landscape of digital credit providers has been changing, and we see differences from around the world. China looks very different from Latin America. Africa looks different. Eastern Europe looks different. And of course, some markets, digital credit providers are still beginning to emerge. But the main categories that we see, particularly coming out of Asia and some of the developed markets, are what we call the tech giants. These are usually industries like, sorry, a little bit of feedback. These are tech giants like Alibaba, Ant Financial. And then we also have P2P lending platforms, particularly in China, but also now rising very quickly in a number of markets. Online payday lenders, they've been around for a long time for consumers, but many of them now are shifting to online platforms. The mobile nano lenders, these are small digital credit provided through mobile devices. And this is very popular, particularly in Africa and parts of Asia. And then, of course, for the SME finance, we see online invoice platforms, supply trade finance, and then a lot of aggregator models, which are slightly different from the P2P platform. Sometimes these are brokers or groups that are gathering loans together, online platforms, as it were, for borrowers to go to. And they have their own issues because they're sometimes just brokers. And then we have online balance sheet lenders, which also make up many of these other industry groups. Again, these are different from P2P platforms because they have their own capital that they're lending, as opposed to P2P, which are primarily just helping broker relationships between different lenders. Next slide. So in addressing consumer risks, many of you are aware of the SMART campaign principles, the 7 principles, which focus primarily on appropriate product design and delivery, transparency, prevention of over-indebtedness, mechanisms for complaint resolution, responsible pricing, fair treatment of clients, privacy of client data, and lastly, one that many of you raised with me as a sort of a separate category is security and fraud prevention. Next slide. Now, I won't be going through all of the risks or the details, but I did want to highlight some of the things that I came across in the research. So on product design and delivery, a lot of it comes about because we see very rapid access. A lot of it is being provided via the mobile channel. We have some models that are designed based on fairly aggressive marketing. And oftentimes, particularly with the mobile channel, what we're finding is that the information just can't be provided the same way it was with face-to-face lending. So there's a particular risk oftentimes with digital lending is in terms of being able to make sure information is actually being provided to clients. So these are some examples of violations that were noted by the Online Lenders Alliance under their mobile best practices. I recommend this. This was actually designed for online lenders, but they're if you look in the paper, I've referenced the Online Lenders Association, Online Lenders Alliance best practices. they give some very good examples about how to approach design issues, particularly on mobile platforms. And you can see some of these, again, when you're using a web-based and converting over to mobile, a lot of times people don't take into account some of the issues. So these are some of the examples that we saw. And again, it's really about getting the right product for the right customer. The use cases, pressure-free loans, and adopting kind of a responsible advertising marketing standards in terms of the way products are designed and delivered. Next slide. In the area of over-indebtedness, we're beginning to see some markets where digital credit, again, because of kind of very rapid availability of credit, and also sometimes issues around how loans are being underwritten, oftentimes using information that doesn't rely really on the ability of a client to repay, more looking at their willingness, particularly for very small loans. So we have issues like in Africa, where we're beginning to see digital lenders who are actually lending for things like sports betting or lottery tickets. Expectations, particularly in digital finance, of venture capital. The bigger the fund, the bigger the exit required. So there's a lot of pressure on digital lenders, particularly where we see a lot of venture capital, much different than we've seen in the past, and hence there's a lot of pressure. We have countries where, in Kenya in particular is a good example, where we see a lot of people being blacklisted for very, very small loans. Again, kind of an over-reliance. This is kind of the negative side on the credit information sharing, but there are issues around credit information sharing. I'd like to mention that in my research, I also came across the International Committee for Credit Reporting, which is doing a lot of very interesting work right now, looking at how to include credit information sharing beyond just regulated institutions, and looking at some of these new financial players, particularly in the digital space, which should also be sharing information. This has become a big issue, particularly in markets like Asia, where people are really bicycling loans, borrowing one to pay another off. Again, we've seen that historically as being a problem in over-indebtedness, and it's become a particular issue, particularly in some of the peer-to-peer lending, where that has become quite popular, especially in Asia, and regulators are looking at that now. Next. Addressing transparency issues, we see two categories here. One for digital borrowers. Again, issues around non-transparent rates and fees. Again, lack of information is provided oftentimes, or people who are skipping certain aspects. So below is an example for CGAP, when they actually worked with a lender to show different approaches for using digital tools that sort of nudge clients to actually read or interact on terms and conditions. So there are challenges, but the digital tools also provide opportunities to actually encourage people to actually access information in an easier to understand approach. So there's a lot of interesting information and some good examples. I think SIGA's done some good work here, also the SMART campaign, in terms of looking at some of the emerging approaches for addressing transparency issues for digital borrowers, and I covered that quite a bit in the report. Next one is, next slide, is transparency issues for P2P investors. Now, many people don't normally look, oftentimes in the, traditionally when we're looking at consumer protection, we're looking only at borrowers. But in digital finance, particularly now with P2P individual small investors, we see issues around also consumer or protecting P2P lenders and the people that invest in them. I think this came about primarily after we saw what happened in China, where an online lender actually ran away with the funds of almost 1 million Chinese who had invested $7.6 billion in a P2P lending scheme. Since that Regulators in China took a very quick approach to that, and this has now been replicated in markets like India and Indonesia, where we see P2P lending growing very rapidly. So there are issues. There's also issues around how data is presented, how it's shared. In doing some research for this report, I even invested in one of these P2P lending models myself, just to be able to see, and I did lose some money. Again, I saw that even the investment information wasn't very transparent, and I learned lessons too. It was a very small amount of money, but I did learn something from actually participating in an investment scheme, just to see what the experience was like from a lender's perspective, an individual lender's perspective. Next. On the area of pricing, this has always been an issue. We see a lot of models, particularly in a lot of these new lending schemes, digital lending schemes, where providers have entered the markets with a model that's based on high losses. This was particularly true in Kenya in the beginning when we got into mobile lending, where the interest rates were very high, flat rates, and basically they just assume high loss rates. And there was inconsistency in terms of being able to compare one group with another. So now we're beginning to see, actually with digital technologies, examples of where you can actually price loans much more accurately than we could with commercial lending. So the model the example I'm showing here is from Lending Club, where they actually have multiple categories that range from 5.3% to 26.7%. In fact, I just checked yesterday, and these now range from about 6% to 30%. But the information is very clear. They have the scales and the rationale behind the scales. So again, you can really differentiate. And in this case, you're looking at almost 5 times difference between the first category to the last category. So you can actually move to a situation where you have much better information. And again, this is an area where regulators and policymakers can encourage industry to come together and make sure that interest rates are following standard practices, and where transparency or the ability to be able to share and compare interest rates can be done. And networks like Smart Campaign, I think, can play a big role in terms of encouraging the industry, somewhat similar to what the original work on Transparency International did in terms of looking at interest rates. Next slide. All right, digital credit and the treatment of clients. We see a lot of issues here in terms of the potential, at least, for discriminatory practices, unfair collection practices, and lack of, again, of disclosure of certain conflicts of interest. So a lot of regulations are coming out. I think one of the areas which was a very hot topic when I was doing this research was the increasing use of algorithms. And algorithms in and of themselves, basically computer big data models that allow a lot of information to be collected, can be quite useful. But we've actually seen some documentation where these algorithms could actually learn to be discriminatory, in the sense that they could find that clients from a particular area, maybe because of tends to be an area where religion or age or race might be a particular issue, and the models could actually learn to discriminate based on factors that they're seeing. So it's very important that in looking at algorithms in particular, that we're actually looking at how these algorithms are designed, and there are tools that help regulators and policymakers take a look at that, just to make sure. And there are lots of things that can be done to help clients, again, making sure that we're not pressuring them to reborrow, no surprise fees, opt-in, opt-out, and collection practices are fair. We've seen some issues with going digital, where digital harassment also occurs. Next slide. Digital privacy and protection is a hot topic right now. particularly in the realm of digital lending, how information is collected, how it's used, whether clients are actually consenting. We saw a lot of models where, particularly in some of the mobile lenders, where they were actually kind of putting a program on the phone to be able to track information, not necessarily spyware, but it wasn't a way to track information that we're actually using on your phone. For a lot of clients, it wasn't an issue, but for others, it can be quite intrusive in terms of tracking where a client is, how they're spelling, or the types of messages, the number of messages, the calls that they place out. And oftentimes clients weren't properly informed. But since that time, I think over the last couple of years, we've begun to see people being much more sensitive to that, and particularly with GDPR policies that have come out, and now ARCO principles that have come out in terms of being able to set some of the standards. This is now something that most regulators and policymakers are very in tune with, particularly with what happened with the EU. Next. So the last two categories were really about mechanisms for complaint resolution. We begin to see that AI can provide some very interesting support for complaint management in terms of being able to help people with their problems. Again, particularly chatbots, an area of interest. Next slide. Cybersecurity and fraud, as I said, has been one that a lot of people raised with me in terms of concerns here, both on the clients who are now just getting into digital for the first time. So many of the things that people who were online for a long time know about spoofing fake emails. Now we're getting kind of these spoofing fake SMS messages or websites, trying to gather information oftentimes, or even obtain loans from clients, or issues about taking funds. We found that I think the most interesting examples of really to stay on top of cybersecurity and fraud was that the policymakers and the industry had a good dialogue. Industry was sharing information, so an attack on one was shared with the industry much more quickly rather than the regulator having to share it. So these were some good examples. Next slide. So there's a lot, I think, in terms of looking at emerging standards for responsible digital credit. We've seen a lot of achievements, but also still some challenges. Industry plays a very important role. There are a number of industry groups who are working on it. I think there's some good models that are happening in various markets where that information and those examples from the industry can be seen as something that could be replicated in other emerging markets, particularly as digital credit becomes more and more important. Regulators and industry groups, groups like the Alliance for Financial Inclusion, I think are very important in the FinCoNet in terms of being able to share information among regulators and policymakers, as well as groups like the Bank for International Settlements, BIS. Next slide. Lastly, I just wanted to bring up the recommendations for that I came out with in the report for the SMART campaign. And SMART campaign is beginning to work on these. Of course, looking at how consumer protection principles for digital finance, not just digital credit, but digital finance broadly, are different from the existing kind of brick and mortar type of lending operations. Again, we brought out where that's going, and I think getting the industry involved is SMART campaign is in a good position to be able to do that. I think there's a value in providing. We've seen a number of groups who looked at certification for digital credit providers. I begin to see marketing and advertising where industry is actually advertising, I am certified by, for example, the Online Lenders Alliance. This would be a great example, I think, for groups to be able to see the SMART campaign, particularly in the new FinTech Protects community of practice, coming up with a certification that industry can adopt and agree to abide to. And lastly, smart tools for digital financial services. I believe, and this is an area we begin to see a couple of regulators that are promoting it, and industry individually, but I think this is an area the future is really using tools like chatbots, which could be used by SMS or social media to be able to empower clients, both to basically make sure they're better informed, get industry behind it, provide information and ways for customers to deal with consumer complaint management. So many of the issues that we talked about can be done and solved. And, you know, I think, I'm not sure if Matt Wallace is joining us, but I was inspired by groups like Matt Wallace and his group, who's been working in Myanmar on Mr. Finance, with basically a financial education tool. And we're seeing regulators now in markets like the Philippines and Ukraine and a few other places. Ghana, I had some discussions really about the role that, particularly with clients using mobile devices, the role that chatbots could play. So I will now turn it over to Alex, and then we'll get into questions from the audience.
Thank you very much, John. And now it is my pleasure to introduce you to Alexandra Rizzi, Senior Director at the Smart Campaign. She leads the campaigns as among many other important roles. She also leads the campaign's FinTech Protects community of practice from her home based in Rome. And Alex is also the technical lead for research projects at the Smart Campaign, and all of the work that the Smart Campaign is doing related to the evolution of the standards of conduct, as well as supporting the campaign's activity in Africa and Asia. Alex has prepared a reply from the Smart Campaign to John's report, and at this moment I would like to call on her. Alex, the floor is yours.
Thanks so much, Pablo, and thanks, John. I think I wanted to kick off our response with a quick poll of the group, which just maybe we can take about 30 seconds. It's to get your feedback on which of the issues that John has talked about, which are the areas of consumer protection that you feel this group feels digital lenders need to do the most work in terms of improving their practices. And we combined a few of the client protection principles together here for the survey. So I'll just give you a few more seconds on that. Oh, great. Interesting. Okay, a bit of a head-to-head on appropriate product design and prevention of over-indebtedness and transparency and responsible pricing, and quite a bit on privacy of client data. So a diversity of opinions in terms of where additional work needs to be done, and so happy to talk a little bit about that in terms of what the Smart Campaign is doing, and in general comment on the paper. And thank you so much, John, for this great work. As Pablo mentioned, I work at the Smart Campaign, and as an industry standard setting body for financial consumer protection, we were very happy to support this paper and are eager to use the results and recommendations. And there are some comments I'd like to make on the paper itself, and then respond to some of John's specific recommendations for the campaign. One of the reasons we were really excited about this paper is that it advances the conversation from client protection risks to client protection solutions on digital credit. Much of the industry discussion in the last few years has very well articulated the risks, client protection risks, the great work coming out of CGAP and from Microsave, the Digital Credit Observatory, Bankable Frontier Associates, and the Smart Campaign has done some work on this as well, and articulating the risks is a very important first step. But we feel that the time is ripe and is now to go from risks to solutions and how to make responsible digital credit implementable. And John articulates the risks in the paper and does that comprehensively, but then he spells out what some of those mitigating practices should be and cites examples from where they exist, such as quite a few from the Online Lenders Alliance, and also makes recommendations for where they don't yet exist. So as John was mentioning, for instance, one area we were quite keen to learn more about was in the area of algorithmic transparency, and potential discrimination, a topic that's been discussed a lot in terms of risks. And the paper talks about those risks, but then makes recommendations for providers to do things like offering opt-out features that allow customers to withhold their personal data, testing and retesting the algorithms for potential bias, and having a documented process for and rationale for the various features and variables that are used as part of the analysis and justified at the organization. So we were excited to see things going from risks to potential solutions. And as a next step, as an industry, we need to get even more into the weeds in terms of implementing these recommendations and doing consensus building and getting feedback from providers, and to get more examples of how providers are putting some of these solutions into practice and recognizing those that are. Another way that we found this paper really helpful was just in sharpening the way we talk about digital credit. Digital credit has been thrown around a lot as a term, but there are many different types of business models that fall under that umbrella, and the paper provides a really useful taxonomy in terms of the different types of providers, from non-bank marketplace lenders to the tech giants to FinTechs doing tiny mobile credit loans, and the paper lays out what the client protection risks are that are inherent to all of these different business models, which were largely the same, which for us was a helpful validation of the client protection principles. But it's extremely important to understand precisely the differences between these business models, as it would shape what you'd ask or expect of them in terms of a solution. So, for example, with responsible underwriting, which is one of the things that John recommends, it might need to look very different at an e-commerce giant like Alibaba versus a mobile credit fintech like Tala, given the differences in the customer data that they have, the pre-existing relationship with the customer, the interface between provider and customer, and the level of market development and regulation that exist where these different types of business models operate. So the paper was really helpful in sharpening our language and how we talk about digital credit. And on a related note, for us, it helped reaffirm the use of the client protection principles and our standards as a helpful framework for analyzing new business models. And what we've been doing at the campaign over the last few years is using the client protection principles as a framework to look at digital credit and other new business models, and identifying which of our existing standards were relevant or not, and in which areas new standards need to be added. But given that the client protection principles were developed primarily for the microfinance industry, we've been eager to affirm their utility in this wider world of financial inclusion. So it was helpful to hear from John that this was a useful lens for a much wider set of actors. And having said that, there were some interesting recommendations from John on expanding that framework. One was the addition of an 8th principle on fraud and security, which is especially salient for digital financial services and digital credit. And he talked about some of those risks, such as phishing and the breaches and abuse of client data. And we completely agree that this is a very serious area of risk. We're doing some ongoing research in Rwanda right now with primarily mobile money clients, and out of 1,200 respondents, 30% told us that they had direct experience with fraud. And so we completely agree on its importance. And while on the one hand, concepts of security and fraud could be housed under areas such as privacy of client data and fair and respectful treatment, given just how important this is in the digital space, where we'll take it into consideration as a potential new principle. And another expansion of the framework in our thinking was, John's reframing of P2P investors as customers as well. And there are definitely some unique client protection concerns there, because as John said, small retail investors are using these models and putting their own investments at risk. And so they require protections as well, especially in areas like disclosure and clear advertising. And John, I didn't realize you had lost money in one of these. I don't know how you categorize that on the expense report, but I'm sorry to hear about that. But that's really interesting research, firsthand exposure. So, and so we were, these two additional kind of expansion of the client protection framework was really interesting for us to learn from the paper. And in terms of responding to the three recommendations that you mentioned at the end of the presentation, one for the campaign, one was developing and implementing standards of practice that use these recommendations for digital credit, and we completely agree that that is the next step, and this paper makes tremendous headway in that direction, along with inputs from some of the groups we've mentioned, like MicroSave and CGAP. And as you said, there's definitely still more work to operationalize the standards of practice, get industry feedback, and test them. And John writes in the paper that there are groups like the Online Lenders Alliance in the United States, which have made progress. There hasn't been as many industry efforts in emerging markets. And from our perspective, we agree that these types of organizations aren't readily apparent in many of the emerging markets where digital credit is being offered. So, and that's one area where we definitely want to get more involved and are already involved. And one example of that is a community of practice called FinTech Protects. And I think it's on the next slide, maybe. There's some example organizations that are part of this. FinTech Protects is a closed community of practice where providers can learn, share, and shape best practices on how to implement responsible digital client protection. And there are quite a few digital credit providers, pay-as-you-go models, and tech-enabled microfinance institutions. And we found that from our experience in the microfinance realm that in standard setting standards with the providers themselves is absolutely integral to having buy-in and success for those, and leads to standards that are aspirational but also workable for the providers. And by working closely with the providers in FinTech Protects to test and learn, it helps build the business case, and it's the opportunity to build the business case for improvements in client protection, as we've seen with our partners in microfinance. And so we're very pleased to be working with this group of organizations. And if anyone is on the webinar is interested in joining, or we'd be very keen to chat with you. And another angle of working to implement the standards is through working with investors through the Social Performance Task Force Investor Working Group and the recently launched Responsible Investor Guidelines. We're looking to support investors to come up with concrete means of evaluating whether through their due diligence and portfolio engagement they're helping their portfolio implement good client protection practices. And extremely important for this work with providers through FinTech Protects to align with what investors are asking of their organizations and to be in conversation. And finally, we're updating a tool for regulators called the Model Legal Framework to reflect many of the risks that John talked about in digital credit. It's a tool for regulators based on the client protection principles, which has been used in the past to develop actual legislation, but it's also been a tool that regulators have used to assess their own client protection regime. So there are a number of ways in which the recommendations, John's first recommendation, are we're taking that and are already working on that and feel encouraged to go even further. The second recommendation was about creation of a certification or another form of recognition for digital credit providers that meet these standards that are increasingly being implemented. And we also completely agree the Smart Campaign certification program, which we've been running since 2013, is an independent evaluation and public recognition for financial service providers who adhere to client protection standards. And we feel it's been an effective tool in advancing client protection in the financial inclusion space, with over 100 financial service providers certified and that serve about more than 42 million clients. And we agree that a similar seal of recognition for digital credit providers, when supported by investors as part of their due diligence or covenants by associations, regulators, and the providers themselves, can be an extremely helpful tool for distinguishing providers from one another and for incentivizing improvement. And we agree so much with that recommendation that we're actually working on that, and as part of adapting our standards for one type of a digital credit provider, mobile credit providers, and integrating that into our certification program this year. And the hope is to launch that next year. So we completely agree with the second recommendation as well. And then, no surprise, we also agree on John's third recommendation of for using technology to both empower consumers and as a client protection solution. And of course, given that the digital credit business models that John's outlined use technology for practically every function and aspect of their work, from marketing to underwriting to disbursement to recourse, the client protection solutions need to leverage and use technology as well. And John gives the example, as you mentioned, of chatbots as a means for effective recourse, and we think it's one of many tech-based client protection solutions. And so, yeah, we see the identification of these types of tools like chatbots or as part of the development of standards process itself, through working with providers and other actors to understand what they're using and how they can help mitigate against client protection risks and empower consumers. So we, in sum, we agree on all counts, and thank you, John, for this work. We encourage everyone to read the full paper and are excited to move forward with the results, and would, if anyone has questions about some of the work streams that I mentioned, be happy to answer further. And I think before we go to Q&A, we wanted to do one more poll, which was to get from the group your thoughts on which incentives will push digital or providers to apply responsible digital lending. Investor understanding the business case, industry recognition, regulation, or other. So maybe we're giving about 30 seconds, I think. Okay, so regulation looks like folks think would be sort of the biggest driver, followed by investor demand, business case, and industry recognition. Yep. And I didn't put clients on here, but I would be curious to see if clients were also part of that. So I guess I'll hand the floor back to Pablo for, I think, to see if there are questions from the audience.
Thank you very much, Alex, for that insightful response. And now for the last 15 minutes of the webinar, we would like to open the floor for a more candid Q&A with both of our presenters, John and Alex. We have received a lot of questions, and we are still receiving a lot of questions through the chat. Unfortunately, we don't have time for all of them, but we will be responding all of them through text message. But out of all of the questions that we're receiving, I want to call upon for the first person to ask the question, Laura Foos, the Executive Director of SPTF, the Social Performance Task Force, who has a question for John. Laura, I don't know if you can hear us.
I can hear you. Can you hear me?
Yes, perfect. Thank you.
Okay, great.
Welcome.
Thank you, John. Thank you, Alex. Great presentation. John, I wanted to go back to one of your slides on the lowering of interest rates and the pricing. And I had a question on whether or not you've seen evidence of these lower rates in developing countries. I know that we've seen evidence of that in more of the developed countries, but in the research that we've been doing in Africa in particular, there's less than a handful of organizations that we can find that are actually rewarding good repayment behavior or differentiating pricing. So that's the first question I have. Second question, like the two promises of digital credit and fintech is that it's going to lower costs and that it will reach those who are previously unbanked. And in both cases, it's a promise still and not really the reality. It seems like digital credit models are reaching the low-hanging fruit consumers as opposed to the harder to reach as well. So if you could speak to those 2 points in your response, to what extent have you seen lower interest rates in developing countries, and then second, reaching out to previously unbanked? Thank you.
John, do you want to?
Sure. I'll respond. Hi, Laura. Thanks for your comments. No, I brought up the example. As I said, I think digital provides us the type of tools and information where we can differentiate, but you are completely correct. Most of the models that we see in emerging markets, particularly as people get into these, and we see that with the examples of Mshwari and others, the models were based on fairly high loss rates, and therefore rates were extremely high, and there were a lot of hidden or opaque penalties in terms of the pricing, and there was a lack of an ability to be able to compare different interest rates across providers. I think what we're seeing in some markets is that people are beginning, China and Kenya and a few other places, we're beginning to see a rise in interest rate caps again. I'm not a big fan of interest rate caps, although even in Russia and some of the other markets, I've seen, sometimes where there did need to be, the regulator had to step in. But to avoid that, again, these tools should provide us with the ability to price risk much better. And I've heard industry talk about trying to get ahead of the regulator, again, to form a group to deal with this issue. If they don't, there will be regulators, in a sense, will be forced to take the easy road by pressure from politicians and others to look at things like interest rate caps. So I think industry has to see that if they're going to continue down this road, the response will be that there'll be, unfortunately, we may see a lot of people who are prevented because the interest rate caps might be actually too low. So again, you're correct that the most models are currently too high. I brought up the one example that I found to be a good one that I was able to actually graphically show, but you're right, it doesn't exist. So this is an area where industry has a big issue, and it was one of the more sensitive areas that I covered in the paper. Your second question, now I've lost the train of thought, was on, oh gosh. Oh yeah, whether it's actually reaching new customers. In some markets, what I have seen is that, in Kenya today, I think anybody with a mobile phone who's had a mobile phone for a period of time and has used M-Pesa today has access to credit, and there are probably 20 different credit providers in that market. That's a unique example. China as well, anybody today who's done anything online or on a mobile phone or bought anything from Alibaba today also has access to credit. So we are beginning to see that in a lot of markets. Payday lending, particularly I see this in Eastern Europe. I was in Ukraine, Russia, Belarus, other markets. I've seen where payday lending has soared, and unfortunately a lot of people are beginning to borrow, particularly in those markets where people were more salaried and didn't have access to credit before. So I would say it's mixed. We see a lot of promise, I think, in some of the mobile lenders. The peer-to-peer lending models, again, we've kind of seen rapid growth. There are a lot of markets. Latin America is now growing actually at a faster rate in peer-to-peer lending models than any other market. Again, it's starting at a very nascent level, but there are, we are beginning to see developments happening. Overall, it's been big. I hope that answers your question.
If I could just add, thanks Laura for the question. This just on the first one about pricing. This has been an area of interest and concern for us as well, in terms of the driving factors behind the relatively eye-popping interest rates with some of these models, especially mobile credit lenders. We've raised it with the FinTech Protects group. There's been some anecdotal sharing with us that prices, some providers are lowering their prices over time, but we haven't kind of examined things systematically. But I think one barrier is just a lack of getting under the hood, so to speak, and understanding how the prices are being driven over time. And one tool for that will be, as I mentioned earlier, we're doing this, adapting our client protection standards for digital credit, and that will involve a number of pilots and assessments of existing digital lenders, where we can understand at a deeper level what's driving prices, how they're if they're and how they're lowering over time, so that we can better speak and advocate for this if it's something that really needs to be addressed at an industry level.
Thank you very much for that, Alex. For the next question, we would like to call upon Juan Carlos Amayoa from the Ministry of Finance in Peru. Juan Carlos, welcome to this webinar, and the floor is yours for your question.
Hello, Pablo. Hello, Alex. Long time from Harvard. Well, I'm not working at the ministry right now. I'm a fintech, and my question is about regulation. What do you think about regulation laws that obligate fintechs to report to credit bureaus? Hello.
Yes, thank you very much for that question, Juan Carlos. Alex, do you want to?
John, do you want to go, or do you want me to go first, or John, do you want to go first?
Oh, yeah.
Yeah, sure. I can handle that. I've been also advising the International Committee on Credit Reporting, who's really looking at this issue. I think overall, it's an important thing. We particularly see this in markets where fintech players, like in China, and in some of the markets like India, Indonesia, are becoming, or in Kenya, for example, becoming very, very prominent players. And once they get to the point where they're getting to be quite important, if they don't have that information in the credit bureau, the issue of overindebtedness is a big concern. And it's important that they're also sharing the credit that's outstanding. So I think it's many markets, they're not able to participate, and most of the industry told me they did want to participate in the credit bureau, and they found it to be a positive thing. So I think each market has to look at this separately, but overall, I would say most industry want to, and regulators are beginning to look at it, and overall, the opinion is that it is a positive development.
Yeah, I would just agree with, I think, the need for credit information sharing, whether it's driven by regulation or in markets where there isn't that regulation, the industry takes efforts to self-regulate. We've seen that in several microfinance markets where providers voluntarily share client blacklists with each other, because I think ultimately it's a win-win for clients and providers to have that amount of data, and because it helps understand the potential credit risk of lending to individuals, and ultimately helps prevent credit bubbles and over-indebtedness. And even if a lot of the loan sizes are a bit small now for some of these mobile credit products, they are growing over time, and I think ultimately credit information sharing is a good thing.
Thank you very much, Alex. For the next question, I would like to call upon Antonique Koning from CCAP, the consultative group to assist the poor. Antonique Koning is a senior financial sector specialist at CCAP. Antonique, welcome.
Yes, thank you. Can you hear me?
Yes, perfect.
Okay. Well, thanks both John and Alex for your presentations. I mean, the report is great. I think there's a lot of food for thought in there. I also was glad that you referenced a lot of the experiments that have been done. And John, you mentioned the fact that we can also use the digital technologies to actually improve a lot on customer protection. So that's great. I just have one question and then one small comment. The question I have is for you, John. The poll just showed us that we all believe, or a good portion of us believe, that regulation is a really important incentivizer for financial service providers to get their act together on this in the digital credit space. And then in the report, you propose that the approach to take on this is really a principles-based approach rather than a rules-based approach. And I was just interested to see what you actually think about whether there might be differences how you tackle this in a market where mobile money is still relatively, and digital credit in particular, is still relatively underdeveloped, versus those markets where, like a Kenya, where things are already hot at the moment. So when you look at your perspectives and focus on your principle-based approach versus rules-based approach, is there any differentiation there between how mature the market is? So that's a question. I just want to add a quick comment. I'm very excited also to see your recommendations around customer empowerment, and that wouldn't surprise some of those on the call that know me and know what I've been working on. But I think it's actually critically important that we also engage financial service providers in helping or advance customer empowerment, basically, and to allow customers to choose and use the services that they see have value and bring value to them in their lives. And I think with digital credit, you mentioned a couple of very good recommendations how we can improve people making the right choices, having a voice, and sharing their complaints if necessary, and also how respect needs to be tackled, which are three of the four components that we focus on in a report on customer empowerment. The fourth one I've missed a little bit in your discourse in the report, and hopefully that report that we produced last year can add a bit on that, and that is actually control. How can you give people more control in managing their digital credit or their financial lives in different ways? And there's actually quite an interesting number of fintechs that I think are trying to use technology and user interfaces to bring more into that. And so I'd be very happy to explain more, to expand more, but I see that time is short and others might have questions too. But I really would like to recommend you also look into that dimension of customer empowerment. Thank you.
Thank you very much, Antonique. John, would you like to comment on what Antonique just mentioned?
Sure. Yeah. No, I think you're completely right. The reason that I was looking at principle-based as opposed to rules-based is that it allows for some flexibility in the markets, particularly as these models are being developed. And so therefore, having a principle as opposed to a specific rule allows for space where a regulator can adapt over time. And I agree, in markets where we see a rise in a particular group or sector, there are enough examples. We don't have to reinvent the wheel. So India was learning from China, Indonesia was learning from the other two in terms of dealing with issues around peer-to-peer lending, where we begin to see a lot of people now using the mobile channel in other parts of Africa. People are looking at the experiences and learning from what happened in Kenya and Tanzania. So I do agree. We need to make sure that we're not over-regulating, but we are staying kind of abreast. So it is a balancing act with most regulators I talked about, and the principle-based approach in the discussions that we had in Berlin and other places allowed for more flexibility. And on your last point on customer empowerment, I completely agree. In fact, I was in Ukraine recently. We actually worked with the banking industry, the fintech industry, and the central bank in coming up with a competition that dealt with a number of issues. And one was helping people with their, developing tools to help people better manage their financial lives. I think that's important. I didn't highlight that particularly in this report, but I have made, I'm very aware of the tools out there. I'm a big fan, I'm a big advocate of it. I do believe that that's a very, very important thing. And again, I use them as well for myself, and I find them very useful. So I do think these tools are very, very important. And I agree with you, Anthony.
Thank you very much, John. Thank you very much to Alex, and thank you very much to everybody who participated in this Q&A. We apologize that we won't have time to get to all of the questions that we are receiving, but we promise to answer those individually and connect everybody separately to John in case we are not able to answer some of those questions ourselves. And we apologize for going a little bit over time, but we appreciate your patience. We will be sharing and sending around both a copy of the full slide deck and a video presentation of this webinar to all of the participants. Once again, I want to thank the panelists for their time this morning, and all of the attendees for their time as well. And we really encourage everybody to download the full report, John's full report from our website, which you can find just by going to the link that is showing on your screen right now. And we hope to see you again soon at our next webinar. Thank you very much to everybody, and have a wonderful morning.
Thank you, Pablo. Thanks, everyone. Thanks, John.